Hi, this is Roger Conrad, editor of Canadian Edge. What I want to talk about today are two things. One, a risk that is largely being imagined by investors, and the other, a risk that you should be aware of. Starting with the mostly imaginary risk. A number of companies continue to convert to corporations, or more importantly, announce what their post-conversion dividends are going to be. We're seeing, again, a very positive reaction in the market to these decisions being made. As I pointed out in the past, a lot of this has to do with simply erasing incredible uncertainty that's prevailed since Halloween of 2006 when the tax on trust was first announced. But whatever the reason, investors are taking these very positively, and every announcement we've seen, including for companies that have announced dividend cuts when they convert, has been taken as very positive. Now, the imagined risk here is what I'm hearing from a number of investors, that 2011, again, poses some sort of doomsday when the taxes kick in and the companies convert. Markets price things in ahead, never behind. And what we've seen in this trust universe is that they were pricing in quite a bit of risk after the 2006 Halloween massacre, and particularly after the 2008 market meltdown, despite the recovery we've seen since the early part of 2009. So again, all these announcements, even those that have involved dividend cuts, have produced positive returns in the stocks. If you didn't like the dividend cut, you had an opportunity still to cash out of that stock and move to something else that did pay a higher yield at a higher price. So again, these are this is something that we talked about again and again over the past few years. That we felt this would be the case. It's playing out. The idea that there's some sort of hidden doomsday down the road, regardless, is completely overblown, fallacious, and in fact, only a handful of companies have not told us what the distribution would be after they convert. So again, at worst, what you're going to have is an appreciating company after they make their announcement. At best, if the dividend is preserved, you get not only a higher share price as the uncertainty goes away, and you get the same dividend yield. And that was the case with Interplus Resources, one of the latest to announce. Of course, Pinwest and Peyto Energy Trust both reduced distributions, and some investors haven't been so happy about that. But again, both these stocks went up actually after making the announcements. So this is not something to worry about. In fact, it's something to look forward to, as we don't really know what management's going to do. As I've said before, I'm not a long-distance mind reader. I can't tell you what people in boardrooms are going to decide their dividends should be as they convert. But all this new tax comes down on the corporate level. There's nothing new on the individual level. In fact, as I pointed out, as companies convert, those that hold them in IRAs will no longer be assessed the 15% Canadian withholding. So it's actually a tax cut for individuals. But all the negatives with this 2011 thing are all on the corporate level. If the company decides to maintain its distribution, as Interplus has, there's nothing that's happened negative for any investor. And again, even if dividends are cut, what we've seen are rallies in these stocks, and again, with just the uncertainty going away. So this is not a risk to be concerned about. In fact, again, something to be positive about. And we'll be talking more and more about the conversions in every issue of Canadian Edge as we get into 2011. The risk I think people should be a little bit more cognizant of today is the fact that we are seeing quite a bit more yield chasing in dividend-paying equities. I've talked before about how investors have favored bonds, eschewed pretty much everything else, and that dividend-paying stocks were trading at very large discounts to the value of or to the prices of bonds, even of the same companies. How some companies actually the bonds were yielding a percentage point or less than what the common stock's yielding. So people haven't really been full-scale buyers up to now of dividend-paying equities like the Canadians. I think we're seeing something of a reversal of that. We're now maybe even moving into the second leg of the rally that began in 2009. We're starting to see more and more companies break out to new all-time highs, and that's not just taking out the 2008 high or making up the damage from the 2008, 2009, but also moving to highs well past where they were in 2006 when trust taxes were announced. So there's a lot of buying coming in, and a lot of it's justified, and if the business is strong behind it, we've increased our buy target to come up right behind it, and then you can buy with confidence. But if a company, one of our picks, is trading at a higher price than our buy target, sit back a little bit. One thing we've learned over the past couple of years in this market is that emotion is very, very thick. In fact, fear is the primary emotion. Right now, I think it's fear of being left out of a rally. But as we've seen again and again, fear of another 2008 debacle ripples through this market, creates lots of selling. And I think we will see lower prices again at some point. Bull markets don't move in a straight line. Nothing goes up in a straight line. We've seen this happen over and over. But time and again, we also see people saying, well, it's going up. I better get in now. The train's leaving the station. I got to jump on. Don't fall into this mentality. Let's keep a disciplined, non-emotional approach as we have for the last 2 years. Let's get in when these things are cheap enough. Let's even set some buy limits at very low prices that if executed, you might want to get into. Let's focus on high quality, but let's not chase anything. And again, very, very important. The flip side of the sell-off the sell-offs that we've seen, the fear-laced sell-offs, is the fear-laced buying or panic buying, if you want to call it that. Institutions in particular, very afraid of being left out of bull markets, and many individuals as well. So everybody wants to buy when things are going up. Again, that's what your emotions tell you. What you need to do, though, is maintain discipline. The buy targets give you that. Thanks for tuning in, and we'll look forward to chatting with you next time.